Alright folks, I know you're waiting for it. We're talking about Netflix stock today. Love to see it. Actually reported earnings after hours here. Stock's down 1%. We'll dig into it, see what's going on. You look historically, I mean, this stock has performed very well over the last 5 years, obviously 401% growth. But has been somewhat stagnant here since 2020, really since July of 2020. Moving up only 16%, not that much for this, all things considered. So we'll take a look at this earnings, see why it's down after relatively stagnant move compared to historical performance. GAAP EPS line of $3.19 comes in, a beat of 63 cents, very nice, and a revenue line of $7.48 billion, up 16.1% year over year. Is in line. So typically this is a company that's a guaranteed beat on both aspects. You've typically seen them beat on revenue every single quarter basically. So that could be part of the reason, but even being in line and growing double digit, not bad at all, especially after a fantastic year they had last year. Global paid net streaming additions at 4.38 million. That's the main thing that matters. 4.38 million compared to a consensus of 1.54. That's crazy. That's way above their estimates, which were very softball, as I said last quarter, softball estimates. They were able to boost it really with an influx of new content, finally. That's where I was always complaining about Netflix. They didn't have the content, but they released a lot of new content, new series of seasons. It's a good time for them for content. Helped gain the subscriber numbers. Global paid memberships at 213.5 compared to 209 consensus. Very nice. Now the guidance here could be another reason why it's down, but I mean just based off of that net adds, I assumed the stock would have been up. Revenue coming in at 7.7 to 7.68 billion consensus, so it's a improvement there, and an EPS line of 80 cents versus a consensus of $1.13. Yikes. Global paid net streaming memberships at 222 compared to 221 consensus, so it's a beat there. They're expecting to add 8.5 million compared to 8.32, which is fantastic when you're talking about year-over-year growth. And again, I think a lot of that is due to this quarter being more heavily impacted by stuff like everyone's talking about Squid Game. It's more heavily impacted by it. It happened this quarter, so should see more net adds this quarter as a result. Let's take a peek and see what that might look like next quarter. But I mean, these are massive numbers. It's crazy to see the stock down after this. And you see, I mean, obviously early reaction was an upward, pretty big upward movement. We're talking about a nice 2% gain nearly, but since then fell off. I'm guessing something on the conference call must have been there. Let's look at the shareholder letter, see what we can have. Now, one thing you can talk about with Netflix is consistent growth here in terms of a revenue line. It's consistently growing, even onto the next forecast coming up here. Very nice year-over-year growth. Obviously slowing, but it's inevitable as companies get larger, and eventually they reach kind of a cap as to how much they could do without really growing rates. So just keep that in consideration. And the net income line looks really good, except for next. I can't believe profit would be the reason it doesn't hit, but who knows? Who knows? I don't know why stock would be down after that, but I mean, this company obviously didn't make profit for a long time, but not quite what you would expect by any means. And the net adds, nice. I mean, it's a nice number, obviously declining, but last year was such a massive hit for them. Nothing too crazy. We saw that in the forecast. Nothing crazy. This is obviously a nice chart here. You see how they raised the forecast here for Q4, which would be massive if they're able to hit it, because you see how giant 2020 was, and really it was a very weak start to 2021. Not shockingly, they level out right around this 2019 line if you average them out, so it really wasn't bad at all, but it was slow for their standard. They talk a little bit about content here. Hours viewed, top 10 series, Bridgerton series, I don't even know it. Money Heist Part 4, no idea. Stranger Things season 3, that was like 8 years ago. They'll never make it. That's wild. I haven't heard half of these. I mean, it is crazy that somehow Stranger Things is still on there. It's wild. Number of accounts watching. I mean, it's a similar story for sure, but you don't see as many of the originals as you might expect with Stranger Things and so on and so forth. And the movies, not bad at all as far as selection. So pretty good. I mean, that's great. I would say definitely we'll look at the balance sheet real quick and see what it has. So total current assets here at 9.4 billion compared to 9.7 billion of it's 9 months ago. So decent comparison here. Looks like a slight decline here in the cash position. Nothing crazy though. Nothing crazy. Total assets in general at 42.7 billion. A lot of assets compared to 39.3. Big growth here in content assets. Yeah, that's the majority of it. So growth in content assets, nice. It's nice for them. Curious if that can count as an asset, but I mean, I don't know how you value it necessarily, but who knows. Liabilities, total current liabilities at 8 billion compared to 7.8, and total liabilities in general sitting at 27.4 compared to 28.2. So they were able to grow assets by quite a bit more. We're talking about a stockholder equity here of 15.3 billion. Very nice. Compared to 11 billion of 9 months ago. So they've really turned this balance sheet around in a great way. It's a really nice looking balance sheet. It's really nice. I mean, what can I say? There's not too much in terms of, I mean, long-term debt line's a little heavy, 15 billion, but nothing's concerning here. Look at what the stock's able to offer. You do have to consider the stock's still trading at a $282 billion market cap with a 66 PE ratio. Forward P is closer to 4, I believe. Actually, should go down after this terrible estimate for the next quarter. Closer to 40, I should say. So it probably goes up, obviously, after this next quarter's estimate. You'll see a higher forward PE ratio, too. But as far as a market cap line, you're talking about a company that in a year, I mean, this year, let me think. This year's probably going to bring in 20 and 29 billion, right around there. Trading at a market cap of 10 times, that is pretty expensive. And the reason why the stock's seen some unfortunate time is because they're not able to keep the growth rates that people are expecting out of the stock. We're talking about they want 20+% growth rate in the revenue line, and they're not able to hit it right now. And that's just because of how big their last year was. It's tough comparables. Great when you're looking 2 years over each other, but we'll see what it looks like. Not a buy in my opinion. I hope you have a good day.